Hello, everyone. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during our question and answer portion today as appropriate. And if you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information and we're happy to reach out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion on today's material. I'd love to introduce you to our presenter today. Wade Slome is the president and founder of Sudoxia Capital Management, LLC, which he founded in Newport Beach, California during 2007. Wade has worked in the investment industry since 1993 and has been a media go-to resource as seen on CNBC and ABC News. He has also been quoted in the Wall Street Journal, USA Today, New York Times, Dow Jones, Investors Business Daily, Bloomberg Smart Money, among other media publications. And I'm going to go ahead and turn the time over to you, Wade.
Great. All right. Thank you, Marcia. Welcome, everyone. Good afternoon. I know people are extremely busy, so I appreciate everyone taking the time to attend today. I'm, as I said before, today's agenda, I'll do a brief introduction, and then we'll talk about the 10 ways to not destroy your money. And then we'll have some closing remarks. And as Marcia said, if you have questions, she can moderate towards the end. This is our legal disclaimer. So our attorneys have graciously counseled us to include this disclosure, which in essence states that today's discussion contains a lot of opinions and not advice. And my remarks should be treated as such. Also worth noting, any reference to past performance is not indicative of future results. With that out of the way, for those of you that do not know me, Marcia gave a brief introduction, and as she said, our firm, Sudoxia Capital Management, is based in Newport Beach. I started in 2008, and this occurred after I worked for about a decade for a company called American Century in Kansas City, where I managed a $20 billion fund. For those of you wondering what the name Sudoxia, where it came from, it's derived from the Greek word for optimism. I also have a lot of fancy educational letters behind my name. I got an MBA from Cornell, my undergraduate degree at UCLA in economics. I also hold what's called a CFA designation, Chartered Financial Analyst, held by less than 2% of advisors. I also carry the CFP, Certified Financial Planner credential. And as far as our firm goes, we primarily manage money for individuals, but we also do financial planning. We manage money for businesses. I have a hedge fund. And yeah, we have 401k accounts and pensions. I've done a number of courses that I've instructed at UCI. specifically for their financial planning. And then also a published author. I've written a couple books. And if you want to learn more about my background, you can just simply Google my name, Wade Slome, or you can check out my books at Amazon. All right, I won't spend too much time on this slide, but this just basically summarizes that we do more than investing. We also help with financial planning with our clients. All right, I don't need to spend more time on that. So here's today's presentation, and the number one way of not destroy, or the number one way to destroy your portfolio, is to watch lots of TV. I watch the news, I read newspapers and social media, but 90% of it, in my view, is garbage. And there's a great quote from Mark Twain, which I agree with, in which he said, "If you don't read the newspaper, you are uninformed. If you do read the newspaper, you are misinformed." And it's true. Most of the people you see on TV are extremely articulate, they're eloquent and polished, but the vast majority of them are economists, strategists, and analysts, and they've never invested a penny themselves during their life. Yet they try to come off as very authoritative in how to invest. There are occasionally investment managers on too, who you need to take with a grain of salt too, because they're trying to sell their strategies. So as the saying goes, don't ask a barber if you need a haircut, or a car salesman if you need a car. You know what the answer is going to be. And every day there's a bond manager on CNBC saying the world is going to end and sell all your stocks. So why would Bill Gross, Ray Dalio, Mohamed El-Erian say that? Because they want you to sell stocks and buy their bonds. And it makes sense if the economy collapses and interest rates go down. But the same goes, especially now, there's a lot of focus on the Federal Reserve, and it's on the news 24/7. So more recently, Federal Reserve Chairman Jerome Powell said that inflation was transitory in early 21. And of course, as that turned out, it was completely wrong. Inflation wasn't transitory. Then at the end of 2021, the Fed predicted interest rates would be at 1% at the end of 22. Wrong again. They ended up at 4.5%, 5% now, and we had the highest increase in more than 40 years. And these examples continue. If you go back to Federal Reserve Chairman Alan Greenspan in 1996, he famously gave his irrational exuberance speech, in which he basically stated that technology stocks were overly inflated. And had you listened to him and sold all your tech stocks, you would have missed an almost quadrupling in value when the NASDAQ went from 1,300 to over 5,000. There's just the examples keep going. Ben Bernanke, the 2008 financial crisis, said the subprime mortgage loans were not a problem. That was wrong again. Subprime loans were at the epicenter of crippling the whole national banking system. But the point of all these stories is to focus on listening to those investors who have been successful over the long run through up and down cycles. For example, people like Warren Buffett, arguably the best investor in the history of mankind and one of the wealthiest humans on the planet. And guess what? He doesn't spend a lot of time making useless predictions, but rather chooses to focus on making fundamentally good investments in good companies at good prices, and leaves all the speculation to everyone else. And that's the philosophy we try to emulate at Sidoxia. All right. Number 2 way to destroy your portfolio is to invest for the short term and try to market time. Another quote, as the great Yoda said, The future is difficult to see, always in motion. The same principle applies to day trading. You may call it day gambling, because over the long run, virtually nobody makes money. I explain this concept by simply asking a rhetorical question. How many day traders do you see on the list of Forbes 100 wealthiest people? None. If you don't believe my assertion that day traders lose money, you can ask any CPA how many of the tax returns they process of day traders actually make money. Certainly there are speculative periods. You can think of Bitcoin going to 60,000 or the tech bubble of 2000. And yes, sure, there will be day traders and speculators that will and can make money in the short run. But like in the housing crisis of 2008, house flippers and speculators eventually got destroyed. The real tough part about investing in the short run is you have to be right twice every time you make a decision. So for example, whatever you buy needs to go up more or down less than whatever you just recently sold. And a lot of times the exact opposite occurs. What you sell in a panic often subsequently goes up because the baby didn't get thrown out with the bathwater, and the investment that you thought on the reverse, when you think the stock is in a safe uptrend, frequently gets clobbered when because it's overvalued when you bought it. The last thing I'll say about the short term is that attempting to market time includes other factors, things like fees, transaction costs, and yes, the word we all love, taxes. So it's not just the emotional aspects of selling in a panic or buying in euphoria. There's all the fees and transaction costs and taxes associated with that. What you should be doing is investing for the long run. And this is a great long-term chart over the last 100 years. And there are a few observations to make note of. First of all, you notice that over the long run, the stock market is basically up about 70% of the time. Now, 2022 certainly was one of the other 30% down year periods. The other thing you can notice from this chart is that politics are irrelevant over the long run. We watch a lot of it day to day. And, in my lifetime, I've lived through about 10 presidents, both Republicans and Democrats. And over that time period, the stock market, I believe, has exploded about 15-fold over that time frame. The other thing when you're talking about politics is I like to remind investors that the president of the United States often gets too much credit and too much blame for whatever the economic or political outcomes are. What we learned from our high school social science class is Congress is made up of the Senate and the House of Representatives. And during most periods, we have gridlock. And even with the gridlock and the constant bickering in Washington, you can see here how the stock market has performed incredibly well. Furthermore, there are millions of other factors other than politics that affect the direction of stock prices. There are factors like interest rates, inflation, globalization, geopolitics, valuations, earnings growth, sales growth, profit margins, wars, foreign exchange rates, monetary policies, and dozens of other factors. So again, over the long run, you're doing yourself a disservice if you focus on too much on any one thing. The next area I want to talk about is those people that ignore fees when investing, because it's extremely important to the growth of your nest egg. If you didn't know already, the investment industry is very sales driven. Many advisors don't make it their job to make money for you, but rather make it their job to make money from you. So it's very important to pay attention to fees and understand the financial motivations of the advisor. One way I like to describe fees is like a leaky faucet. You may notice a leak over a day or a week, but over a month, or you may not notice over a day or a week, but over a month, you're likely to get a huge water bill. Or over a significant period of time, even a small pinhole leak can cause extreme water damage to floors, ceilings, and walls. I mean, your whole house. And that's the way fees work. Many people don't realize that the cumulative costs from product fees, transaction fees, and hidden fees can average upwards of 2.5% or more. And these can be extremely harmful to your savings over the long run. So it's important to not forget, the lower your costs or fees, the more money you keep, which can accelerate your path to retirement or lead to a higher quality of life during retirement. So I ask, do you want to vacation at the Motel 6 off your local freeway? Or would you prefer vacationing at a Four Seasons somewhere in Europe? I think you know my answer. And this next chart kind of illustrates how these fees can affect your quality of life. In up markets, when the rising tide lifts all boats, people may not pay a whole lot of attention to fees. But as you can see from this 30-year illustration, fees can be extremely damaging and corrosive to your savings over the long run. Here you can see the difference between an individual being charged a 1% fee versus someone paying an annual 3% fee. The difference is quite staggering, as evidenced here. There's more than a $2 million difference. At a 1% fee, your portfolio grows to roughly 5 million in this example versus 2.8 million when charged a 3% fee. A lot of time investors are unaware of the fees they're being charged because advisors sell products with hidden or embedded fees that are missed in the small print. And so I would really urge you, if you don't know what you're paying in fees, simply ask and have the advisor provide the answer to you in a written form, so that you can feel comfortable that you know what you're actually paying. All right, moving on. The number 4 way of destroying your portfolio is to rely on technical analysis to invest. For those of you who don't know what technical analysis is, I like to refer to it as reading tea leaves. One form of technical analysis is the method of evaluating historical price patterns with the hope of being able to predict future prices. The academic data supporting the usefulness of price patterns for profits is very scarce. Warren Buffett, who I mentioned earlier, is famous for saying, "I realized technical analysis didn't work when I turned the charts upside down and I got the same answer." Another investment Hall of Famer, Peter Lynch, profoundly stated, "Charts are great for predicting the past." So here are a few examples of technical analysis. The first one is a double top, which is supposed to indicate an undesirable pattern that will lead to declining prices. But of course, if you look at this pattern from a slightly different perspective, it also looks like a triple bottom. which is supposed to lead to rising prices. So which one is it? Are prices supposed to fall or rise? It's not very clear to me. Next, you have a declining trend line, which is supposed to be negative for the direction of future prices. People use this stuff all the time on stocks, but I always wonder, if it works so great on stocks, why wouldn't people just go on Zillow and sell all the homes that are going down in price and buy all the homes that are going up in value? The strategy doesn't make a lot of intuitive sense. So why should it make sense for stocks is my contention. But regardless of your beliefs, technical analysis tells you to invest based on reading the tea leaves. At the bottom are a few other examples, including a Head and Shoulders, although it doesn't look like that person has a neck. But anyway, moving on. Number 5, panic sell and panic buy for greed, or their consequences to panicking. And we saw this in the panic of energy stocks that were being sold during COVID, when oil prices actually temporarily went negative. Besides panic selling, it's also important to not panic on the way up. Most of you are familiar with the concept of FOMO, the fear of missing out. You can think of people buying Bitcoin, as I mentioned earlier, at the peak of $60,000, or the example of those buying Tesla stock after a 20-fold increase over a short period of 2 years. Generally speaking, the panic strategy doesn't work out very well. In my world, panicking is the equivalent of following the herd. And as the saying goes, the herd is eventually led to the slaughterhouse. Another way of processing this concept is to consider your own personal behavior by asking yourself whether you make the best decisions when you are extremely emotional. The short answer is probably not. This is a dated but interesting slide because the results still hold today. This chart essentially shows on the far right red column that individual investors are emotional, and therefore they typically buy high and sell low, the opposite of optimal, which then leads to dramatic underperformance. Professionals are in the middle, and they're emotional too, just a little less emotional. And the best results are achieved on the far left of the chart, which is the index. And you can think of the index as an unemotional robot investing that does not succumb to the negative behavioral biases. Number 6 way to destroy your investment portfolio is to ignore valuations and yield. I like to explain the concept this way. Would you buy a car, a house, or a boat without looking at the price? Essentially, that's what most traders and individual investors do every day. The difficult part about investing in the stock market is it's not comparable to a supermarket. In the stock market, there are no visible prices. The share price you see on every stock is completely irrelevant. And I'll explain on the next slide with an example. Evaluating the price of a value or value of a stock, believe it or not, takes a lot of training. It will take another long, geeky webinar to explain that in more detail. But rather than ignoring valuation yields, you should value stocks by analyzing ratios, not prices. Examples of important ratios to consider would include things like the price earnings ratio, price to cash flow, price to book value, price to sales, or enterprise value to EBITDA, which is a metric of profitability. So to hammer home this idea, I will ask you, which stock would you prefer? Is a cheaper stock better than a higher price stock, or vice versa? And the rhetorical answer, of course, is it depends. You can't just look at the price. So this is a little small to read on your screen, but the top is Bed Bath & Beyond. This is in the news recently because they just declared bankruptcy. When I created the graph, the stock was trading at $1.50. Today, I think it's around 20 cents. It's the stock price isn't all the way down to zero quite yet. So in other words, even if you bought it today, you could still lose 100% of your money. So it doesn't matter what it's done in the past. The company, after announcing their bankruptcy, could theoretically liquidate all its assets, and without enough proceeds to pay off all its debtors and creditors, there wouldn't be anything left over for the stockholders. On the flip side, if the company were somehow to miraculously cut costs, close its money-losing stores, and return to profitability, you could theoretically triple your money from, let's say, 20 cents to 60 cents. A contrasting stock is Berkshire Hathaway, owned by Warren Buffett, and one share is $462,000, and this company is worth $675 billion. But that doesn't necessarily mean that the higher price stock is going to do better in the future. It really requires analysis, and there's a lot of volatility. But the main point of all this is you can't just look at the stock price to make an investment decision. You need to understand how to measure value. Okay, next way to destroy value is to buy and forget. So just because something is a good investment for a long time doesn't mean it's going to be a good investment forever. For example, we've owned Amazon, Tesla, and Apple for years, and we've made a lot of money. That doesn't mean we haven't sold shares, and it doesn't mean that we believe that they're the best future investments. Even Warren Buffett, who I've mentioned multiple times, appreciates this concept. In the 1980s, he bought World Book Encyclopedia and owned it for more than a decade before there was this thing called the internet and Wikipedia that came along and essentially made his investment obsolete. Again, you can't just buy and forget. Even at Sidoxia, we're long-term investors. Over time, there can be plenty of reasons to sell. There could be new competition. We just mentioned Bed Bath & Beyond. They've been hurt by this company called Amazon, who has eaten a lot of retailers' lunch. Companies could face cost pressures, slowing growth, management changes, high excessive valuations, change in regulations. They could lose market share, product obsolescence, and a whole host of other factors. I think you get the idea, but the main point is that things never remain static forever, even for great companies. So don't just buy and forget about something forever. All right, we're getting closer to number 10. Next, we have over-concentrating your portfolio. This can be very damaging to your portfolio. You can think of the 2000 tech bubble as one example. So many people lost their shirt because they were overly concentrated with too many technology stocks in their portfolio. In the 1970s, we experienced the Nifty 50 stocks, which again were a concentrated group of stocks that eventually crashed very hard. And, as the saying goes, if you lean too far to one side of the boat will eventually tip over. And even today, we're seeing some of this concentration issue rear its ugly head in the S&P 500, with the top 5 stocks accounting for more than 20% of the index values. Things like Microsoft, Amazon, Google, Apple, etc. So, all these examples should point out you should definitely remain aware of your concentration in your investment portfolio. The whole idea behind diversification is to not put all your eggs in one basket. So if properly implemented, diversification should act as a shock absorber to the volatility in your investment portfolio. Diversification is really the only free lunch you can get in the field of finance. And what that basically means is that diversification allows you to earn the same return or higher on a portfolio while simultaneously assuming less risk. So the same or higher return with less risk, that's a pretty good proposition. And that's what this chart shows. By mixing 2 risky assets together, you get a smoother, less volatile portfolio. Number 9, stuffing money under your mattress is especially relevant today in a world where we're experiencing higher above average inflation. So, one way of thinking about inflation is like a melting ice cube. If inflation goes up by 10% in a year, the money you stuff under your mattress or place in your checking account will be worth 10% less next year, which is why it's so important to efficiently invest your money during these periods of heightened inflation like we're experiencing today. And last but not least, a sure way to destroy your value is to forget your mistakes, which leads you to repeat your mistakes. As Albert Einstein said, insanity is the definition of doing the same thing over and over again, but expecting different results. None of us are perfect, myself included, and my significant other reminds me of that. But do yourself a favor and make a concerted effort to be disciplined by remembering and logging your mistakes. You can touch the stove burner once, but learn from that mistake and try not to do it again. All right, that concludes our presentation today. And with that, I will turn it over to Marche for any questions that we may have.
All right, we do have some questions here, and I will tell attendees if you have more questions while we're doing this portion of the webinar, go ahead and type those in the chat. So here's a question. How do you get past the misinformation that is out there about financial matters? Who can you trust?
Yeah, it's a good question. I spent a good amount of time telling person to ignore most of the people you see on TV and really focus on those investment managers that have a long, successful track record. So it does require listeners, people that consume media, to do a little bit of homework and research on the background of the information. But I think the real way to do it is to educate yourself. And one of the ways you do that is with the webinar that you're doing right now. But I would encourage you to, read books. I mean, you could go to my website. I have the blog Investing Caffeine. I have a list of, my top books and investors I like to follow. But any educational book about investing that doesn't have a biased angle or direction, where they have kind of an agenda. So I would just encourage to read as much as possible, but not so much opinions, but rather concepts and tangible educational topics.
All right, thank you so much. So it's interesting how you talked about the best results on one of those slides about, I think I'll pull it up here just a second. You had a question about this slide. The average equity fund, the stock market, the average investor. How can you stay away from emotional investing, and how do you know that your advisor is not necessarily falling prey to some of those same issues?
Yeah. I mean, the short answer is that 70% of professionals underperform the passive index. And the only real way to do and track it is to compare your portfolio that's invested with the advisor to the so-called benchmarks or the indexes. And so it kind of behooves the investor to ask their advisor for that information. So at Sedoxia, that's something we provide to our clients on a quarterly basis. And we basically say, hey, Mr. or Mrs. Client, here's your performance, not only for the quarter, but kind of your cumulative performance. And how does it compare on an apples to apples basis versus the indexes? And, we're first to point out that, we're not going to always outperform. And, that shouldn't be the expectation for any investor. But we're kind of proud of our long-term performance, and we share that track record with our clients.
All right, here's another question. You talked about finding your fees. Is there an easy way to find that out on, say, like a statement from your 401k or your other investments?
Yeah, it's difficult, even for myself. I've been in the industry for 30 years, and we have prospective clients come in and share their statements with us. And, I'm not going to lie, it takes us a while to really dig in. You really have to look into the small print. But like I said, the best way to do it is to, ask your advisor, and I would do it in writing. Send he or she an email and say, what are the fees that I'm paying? And if you get a lukewarm response, that should be a yellow or red flag. But you can, if you're invested in funds, like an exchange traded fund, an index fund, or a mutual fund, I would advise investors to go to morningstar.com, and all you have to do is simply put in the ticker symbol, and with a little click here or there, it's pretty clear what the annual fee is. Now, if you're looking at your statements, most brokerage account statements, if it's Charles Schwab, TD Ameritrade, Fidelity, even the wirehouses like Merrill Lynch or UBS, there should be on the statement on a monthly or quarterly basis what the investment advisor fee is. But as I indicated, there can be a lot of other embedded fees or small print fees that are layered on top. And so, read through as much of the detail of the statements as you can, but oftentimes that's not enough. You're going to have to ask some additional questions.
And I'm assuming this is something you can ask your advisor to help you with. And if you don't have one, that might be a reason to talk to one. Is that correct?
Yeah, and you can check the background of your advisor. There's the broker check. You want to make sure that they don't have any checkered past. I spent a good amount of time at the beginning talk about credentials. Since it's a sales-driven industry, not all credentials are created equally. So yeah, you definitely should do some homework if you're considering a new advisor, and look at their education background, and also, check their regulatory background if they have any blemishes dealing with other clients.
All right. You talked about logging your mistakes. Can you give an example of maybe a mistake that people are commonly making that they might need to have a record that they made that mistake?
Well, for me as investing, it's mostly the emotional mistakes. And typically when you're reading about something in the newspaper, everybody knows about it. We don't have a lot of exposure to the banking industry, but with the Silicon Valley Bank, having its closure issue with all of the bank run on deposits, the bank index was down 25% in 1 month. I'm not saying that bank stocks are a great buy here or not, but I would also say selling all your banks if you have them may not be the best advice too. So it's just important to kind of track your emotional decisions and see how those emotional decisions turn out, not overnight or over a month, but over a year, over 2 years or 3 years. And the more you're aware of how your emotions cause you to make bad decisions, it just forces you to be more objective when you make the decisions. Look at the facts, and look at the valuation and ratios and things like that. And that's what we try to do. And we're definitely not right all the time, but I think, in our profession, experience really does matter. And the more experience you have and keeping track of your mistakes, hopefully fewer you'll make in the future.
Well, that's a good one to end on. And so I want to thank everyone for being here. We want to thank Wade for providing his expertise, and for the organizations that have made this webinar possible to today. To our attendees, look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.